It leads us to our talk of the tape, whether the bear case is finally finished. Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, here with me once again at Post 9. You want to answer that question? Is the bear case dead?
At least through the end of the year. I think that the fact that we have neutralized the Fed risk right now, given the CPI print, what it does is it can spark a positioning chase through the end of the year. We pass through that resistance that we've been talking about, that 4,400 level, that 100-day moving average. What that does is that it draws people back into the market and likely causes positioning to really get from what right now is just overweight to being much more overweight. There's room for that into the end of the year.
But if the bear case is built primarily on the foundation of recession, right? That's pretty much what it is, right? Inflation remains high. You're going to cause a recession because the Fed's going to have to continue to hike. It's getting a little flimsy, isn't it? A little tired?
It is. And if we think about the best case scenario for stocks is one where growth remains robust. So you deliver on the earnings growth that's already being forecasted and the Fed becomes easier and kinder, which means that you get good earnings and you can sustain an elevated multiple because the Fed isn't having to raise interest rates as much, which would put downward pressure on multiples.
But you can't say that's the base case yet?
Well, I think that's what this data makes more a higher probability.
Okay.
And that's why markets are rallying so much.
Yeah, I mean, Dow's up nearly 550 points. We're pretty much at the highs of the day. I mean, how unlikely does that sound to you? That, okay, inflation is going to continue to come down, earnings are going to stay up enough, and the economy is just going to stay strong enough, and that all of the naysayers are just going to have to take their arguments and go home and get invested?
I think that where we have to have that discipline and what we'll be watching really closely is things like sentiment. Does sentiment get stretched? Does positioning get stretched? Where do valuations stand? Because all of the fundamentals can remain very attractive, but if we get extended on those things, we have a setup that could be similar to early 2022, where, of course, you had very stretched measures on that side of things. We're not at that point yet, so those things are not a risk in and of itself, but that's where the discipline as we go into 2024 will come. When
you sat down, you said, hey, did you see the B of A fund manager survey, which I did, which shows, people are looking for yields to come down and bonds to go up a lot. And there's a lot of buying of bonds. They're expecting a bond rally now. Yeah, that is very consensus now. And I think that that should be something that we keep in the back of our mind, because when something becomes so very consensus, the pain trade is usually the opposite direction. That fund manager survey showed that people are the most long or overweight bonds since 2009. It's a record number of participants saying that they expect rates to fall. And so because that is so consensus, I do think that we should probably be open-minded to things moving in the other direction. All right. So, one of the arguments has been for at least a year is that there are just alternatives, whether it is bonds or cash. So we have to chip away at both of those. Now, maybe we can't chip away at the bond argument yet if you think that yields are going to come down and bonds are going to have a potential rip in front of us. But what about cash? If yields are going to come down, are we going to get money out of money markets and into the stock market? It could be possible if we have that soft landing, in the sense that in a recession, in a non-recessionary scenario, yields fall because you get that pressure of the Fed coming off, the Fed possibly doing some of those insurance cuts that can then cause people, as they start seeing the cash yield move down, rotate into equities, as long as you don't have the earnings risk. So I think the thing that we'll be watching really closely is, does the market confirm the soft landing as we go into 2024? If the market remains really resilient and robust, it's effectively saying we don't need those insurance cuts, but the Fed is still going to give them to us. See, because we're thinking, there is the argument that, well, if the Fed cuts, it's because it's desperation. They have to, because the economy has gone into the tank, which leads them to have to cut. You're talking about a different kind of cut, that being insurance, as you say, which means the story remains intact. They're just doing it because they can. They're doing it because they can, and the parallel that comes to mind, of course, is 1995. Now, 1995, they did 3 cuts starting in the summer, and there was recession fears during that time. The market didn't confirm it. The interesting thing, they cut, and the Dow was already at an all-time high, which effectively is saying that the market didn't believe that the cuts were necessary. So if they dust off the 95 playbook, that's where you could see them do a little tweak lower in rates. That doesn't necessarily mean the 100, 200 basis points that is expected by some participants. Okay. So